Whenever any market is elevated, we know what happens next. It either keeps going or it corrects in some way. No one wants to live their life expecting the sky to fall, of course, but occasionally just to understand the risk and to understand why our optimism is valid at the very least, we need to understand the other side. We need to know where the bottom of that pool is if we're going to learn how to swim. So today, I really want you to open your mind and understand this perspective so that you can be a better informed investor and hopefully continue to build wealth for the new world that we're heading into. Hope you enjoyed this one. If you do get some value out of it, please do subscribe to this channel. Give us a like, leave us a comment. What do you think? Is 2025 the year of the credit crisis, the year it all falls down, or is it going to be business as usual? Welcome, everybody, to the Everyday Investor Podcast. Today, I'm joined with Alasdair Macleod over in England, prolific writer on Substack under Macleod Finance, I think it is. How are you, Alasdair?
That's correct. I'm very well, and thank you for having me on.
We've got a lot to talk about. And just to kick it off and to lay a foundation, and by all means, take as long as you want to here, I'm going to quote JP Morgan 1 year before the commencement of the US Fed. Money is gold and nothing else. So to start with, can you just explain to our audience what the difference is between money and credit?
Well, he was absolutely right. And John Pierpont Morgan was the most senior banker in the world at that time. Founder of the eponymous Morgan banks, if you like, including JP. The reason he said that is that in those days we were on a gold standard, and it was really quite clear to everybody the truth in what he said. Basically, the difference between money and credit was established in Roman law going back as far as the 12 tables, which were 448 BC. So we're talking well-established law. In Roman law, jurors then took the 12 tables, that basic definition out of I think it was tablet 7, took the basic definition and then worked on it. This eventually was all confirmed in Justinian's Pandex, which was about 1,000 years later. And of course, the Roman Empire, it was out of the Roman Empire that all the European nations, really from the Urals to Portugal, came from. So it's all embodied in our common law, and also in America's common law, also New Zealand, also Australia, everywhere, simply because we exported the basis of our laws when we Europeans, if you like, colonized the world. The Chinese worked on a slightly different basis, but nonetheless, it was at about the time of the 12 tables that Confucius came in. So, Confucian theory, morality, and all the rest of it, which is still very much a thread behind Chinese law, they came to the same independent conclusion that, there was such a thing as money, and there was such a thing as the promise of settlement in money, which is credit. The way to distinguish between money and credit is that money, which is metallic, has no counterparty risk whatsoever. At the time of the 12 tables, money wasn't so much. Gold wasn't used as money by the Romans. In fact, they used a coin of bronze, which weighed around about 1 Roman pound at the time. So it was a pound for a pound. So gold and silver actually came in later. But nonetheless, gold's durability, and all those sort of qualities and all the rest of it just made it the most suitable element, if you like, for money. So that's the origin of money. Now, credit obviously has its value attached to money. So if you and I were entering into a transaction, and you sell me something, and I say, well, I tell you what, Darcy, I promise to pay you when I got the funds in 3 weeks' time. Yeah, That is credit. You are giving me credit for final settlement in money. Now, where this sort of changed was when we went off gold standards, and it's happened through history various times. Governments or the state or whatever have decided to suspend or do away with that final settlement and replace it with their own currencies. But currencies are credit. If you look at a central bank's balance sheet, you can see quite plainly that currency in issue, both in terms of notes and also what are called bank reserves, commercial bank reserves. In other words, electronic records of money owed by the central bank to commercial banks. That's all on the balance sheet. There's a counterparty risk there. Now, okay, under normal circumstances, we would assume that the central bank isn't a significant counterparty risk. But when that assumption starts getting questioned, of course, it then really matters what the difference between real money, which is gold without counterparty risk, and credit really is. So everything we do nowadays is actually credit, absolutely everything. And it's not just in the banking system. I mean, if you want to educate a child, for example, we all do this as parents. We will say to a child, okay, you go to university, I will fund you. What you are doing is you are giving credit to the child. The child has, in effect, a debt to you for funding his education. Now, the debt doesn't necessarily get called in. Someone does some work for you on your house. Now, he will do the work first and then expect payment. He's giving you credit for his work. A bank deposit, you think you might own, money in the bank. You don't. The bank actually owes you, it's got a debt to you. Now, if you find that you can't draw on that debt under the terms, if you like, of your bank account, then you begin to think, hold on a minute, this bank is not honoring its obligations. That is, the other side of credit is always an obligation to pay. That's the whole thing. In practice nowadays, of course, credit just circulates and circulates and circulates. You and I, going back to this transaction, in 3 weeks' time, I give a bank transfer to your bank and you and I are square. Okay, that's fine. But someone else, you and I are square, but you now have a balance, if you like, in your bank, which is a deposit owed to you by your bank. So in other words, you've still got the credit, you're still due credit, as it were, but it's gone from me to your bank. And the only way in which credit gets expunged, basically, is when people, when the debt obligation defaults. So this is incidentally different from money supply, because if you look at money supply, it actually excludes bank reserves, or if you like, base money at the central bank. It excludes the bank reserves because bank reserves at the central bank are not in public circulation. Money supply is doing something slightly different. But absolutely everything's credit. I mean, if you own shares in a company, or Americans call it stock in a corporation, that is credit. I mean, you may not think so, but under those circumstances, what happens is that the company management, have an obligation to deliver to you as a shareholder a stream of income, or at least to retain profits in the company on your behalf. This is credit. You're taking credit. And even worse than that, when you've got, a sort of quasi-government organization in the middle, acting, if you like, to replace certificated ownership, that's a further credit. So what you have a chain, when this is actually quite worrying, because you have a chain, if you like, between a corporation and its shareholders. You've got interposed in the middle of that someone like the DTC or Euroclear or whatever. So the company owes the obligation to Euroclear, and then Euroclear owes the obligation to you. Now, this is essential to understand, and this is actually quite serious, because if, let us say, there is a general meltdown or whatever, you could find a situation where, the Euroclear, who might have lots and lots of defaults through the system, finds that it takes what you think is your property and uses it as collateral to obtain the credit to continue. So, in other words, it's not your property at all. And not only is it not your property, it's not even Euroclear's property. But Euroclear have a prior charge on it over you. Yep. So this is important.
It
Desperately
is.
important to understand what credit is.
Yeah.
And as I say, if you look at the totality of credit, the only way in which it gets expunged is through defaults today.
Okay.
There is another minor way of doing it, and that is that I acquire gold, money, if you like, but that has to come from someone who didn't acquire it through credit. Because what I'm going to do is I buy gold, okay, and I pay you. And let's say I buy gold, I pay you, and again I do it by bank transfer. I've got the gold, you got the credit, or putting it more alarmingly, I got gold and you got the experience. So that's the difference.
Okay. Like there's a lot in that, and I think like just to break it down even simpler, just tell me if this is a correct way to look at it, and I guess it probably takes a while just to follow through that chain of events. But if I was to buy, say, a piece of real estate and I enter into a sale and purchase agreement, I am entering into that agreement on one day, but settlement might be in 2 or 3 months' time. That's when the
Yeah.
actual money or value is being exchanged, but the credit actually event happens when the contract is entered into. Would that be true? But in a
Well,
credit
you've
world,
got
we never get that.
yeah, you've got two elements of credit here because there is a credit, if you like, we enter into an agreement that on a future date you will pay for the property. But then when the property is paid for, it is again paid for in credit.
Ah, okay. There's
Now,
really hard to get away from it, apart from, like you say,
you,
working, like trading labor
yeah,
directly for gold, right?
yeah, you can't get away from it. It's actually as simple as that. I
Okay.
mean, you might think that sort of coin is money, but it's not anymore because coin is all base. You don't get gold coins in circulate. The other thing, of course, is that if anyone gets hold of gold coins, it's the last thing that they'll put into circulation. I mean,
Yeah.
are we going to run out and spend our silver and gold coins when there's credit around? No,
Of course not.
certainly not.
That's Gresham's law, right? Keep the good money,
Exactly,
get rid of the old.
exactly.
Yeah, get rid of the
Yeah,
bad. So,
exactly,
so when
exactly.
we kind of hear this term credit crisis, talk me through what that means to start with. Like, what are the events that would potentially lead to a credit crisis where the financial system now is effectively, I guess, seized up, for lack of a better term?
I mean, now that you understand the concept of credit, it can be expanded infinitely. I mean, going back to a relationship between you and me, uh, you know, I could say, Darcy, I think you're a wonderful guy. I'm gonna send you some pounds or whatever. And it just comes out of thin air, if you like. Credit comes out of thin air. You know,
Mm.
eventually it might be exchanged for other credit or whatever, and you and I will appear to have settled something between us. But you know, essentially the credit has been passed on elsewhere. Banks have exactly the same facility. They can create credit out of thin air, and they do it by creating loans out of thin air. So I'll give you an example. Let's say you want to borrow some money from the bank. You go into the bank, you tell them you got this project, and you would require an overdraft facility. You would like to draw down, let's say, $1,000 or whatever. So the bank, if they think that this is a sensible proposition, and they will get their money back at the end of the day at whatever interest, then they will agree, and they will ask you to sign the papers. And so you say, fine. And as you go out of the door, the bank manager will shake your hand and he will say, Darcy, the money is now in your account. Now, what that means in accounting terms is that on one side of the balance sheet, the bank manager has created a loan,
Mm.
but he has to balance it on the other side of his balance sheet. Now, this may not be reflected in, your actual account, but on the other side of the bank's balance sheet will be a deposit. The deposit is the same as the loan, okay? Until you draw it down, in which case both sides of the balance sheet will diminish. This is created out of thin air.
Mm.
Now, this is the way banking works. Banks, if you like, I mean, basically they're dealers in credit. If that's the way to understand it. They will lend to you, say, at 10%, and the deposit on the other side will be zero.
Mm.
Or if they need to attract deposit from someone else because deposits have been going out into other banks, and so they've got to balance the situation. Then they may have to pay up in order to, attract the sufficient deposits in to balance the balance sheet. So that's their dealers in credit. And what banks do is they will leverage their capital because they don't need to spend their capital. They don't need to deploy their capital in creating loans at all. That's a completely different issue. The capital is there, if you like, as a sort of backstop when things go wrong.
Right.
So, typically, a bank's balance sheet leverage between assets and its equity in normal times would be somewhere between 8 and 10 times. Yeah. Now, this way, they leverage up that margin, in interest between their loans and their deposits. So that's simple to understand. But because they can leverage it up at any particular time, if a bank feels that the general prospects, if you like, for the loan business are improving, then they will leverage up their balance sheet somewhat more, so that you will go from, say, 8 to 10 times to 10 to 12 times. Now, this obviously, if this is a mistake, then there is an increased risk that there will be write-offs, which will impact the value of the bank's capital. Mm. So leverage is very, very important. But you can see that when you get a sort of cycle, if you like, of what the Austrian economists call a business cycle. In other words, things are never stable. You get, an improvement in business conditions, and then, that sort of means that credit has expanded because the banks have expanded their balance sheets. That then, the extra credit going into the economy tends to, drive up prices a bit. And then suddenly you find that the assumptions that were behind the business calculations when businesses went out to borrow from the banks in the first place suddenly start coming unstuck. The bank then becomes very, very aware of the increased risk to his balance sheet, so he will try and curtail his lending. Yeah. Now, the only way, as I say, in which that can really be curtailed as a whole, an individual bank can reduce its balance sheet. Okay, that's not a problem. But the entire banking system can't do that. The only way in which that can happen is if you get defaults. A bank under these circumstances will have to de-risk itself by lending to, sort of better credit. And that better credit is likely nowadays to be governments rather than the private sector. So you will find that the private sector suddenly sort of starts, as we call it, going into recession, because what's happened is that credit has been withdrawn from the private sector and then, reapplied to the government sector, which, particularly with regulators nowadays determining these things, is the risk-free alternative to private sector lending. These shifts occur all the time. Now, the problem is that when banks get their balance sheets leveraged up, what you see is an increase in the amount of credit in the economy, and that credit feeds into all sorts of things. I mean, it feeds into stock prices, for example. So you think that stock prices rise because the economic outlook is improving, whatever. Well, actually, more accurately, the reason they rise is the credit is available to pay for higher prices for stocks. That's actually what it's about. So credit is, if you like, the engine of all the financial instruments and their values, the availability of credit. Now, obviously, when banks start getting worried and they withdraw this credit, then this credit bubble starts to implode. Where we are today is that we have a system whereby the central banks will do their utmost to ensure that when the banks start de-risking their balance sheets, that corporations and therefore banks and all the rest of it won't fail. So what they do is they whip interest rates down in order to stop failures. And the result is that you get an accumulation of malinvestment, zombie companies, whatever, and they get saved by the Fed or by the, ECB, Bank of Japan, whatever. So we've had an accumulation of credit bubbles really since the banking system was financialized after Big Bang in London in 1985, 84, 85. And I think there's probably about six bubbles, if you like, that have occurred. And each of those bubbles has not been permitted to wash out all the bad debts in the system. So there's been an accumulation of bad debts. Now, we are now in the position where we are in the biggest dollar-based credit bubble ever seen in history. And it's completely detached from the value of money. Credit is no longer attached to the value of money.
Hmm.
So this is why you see the gold price rising. It's not the gold price rising. It's falling currencies reflecting currency risk. Now, when you look at that and you understand that, we've got the question of interest rates. Interest rates are not a reflection, if you like, of just supply and demand in the economy for credit. No, they are a reflection of the risk that someone, let us say, taking a credit obligation, taking on credit
Hmm.
from, let's say they're taking on dollars. Dollars are credit, as I've just laid out. If they're looking at dollars and they sort of think, okay, the proposition is to lend money to the US government, say on 10 years, currently yielding 4.5%. Do I buy it or not? I mean, the answer basically is in a further question, and that is, what do I, as a foreigner or as an investing institution, think the purchasing power of the dollar is going to do between now and a year's time?
Hmm.
Is it going to decline by less than 4.5%, in which case buying a 10-year bond is a sensible proposition? Or is it likely to decline by more than 4.5%, in which case this is a bad deal? Now, you can see that with the risk increasing in dollar credit generally, that actually what interest rates are telling us is that there is increased risk. This, if you like, has to be compensation for holding dollars. So foreigners are increasingly taking the view that this dollar, the dollar is dollar rates are too cheap, too low. So as a result, dollar bond yields rise. And this is what happened. And it caught everybody on the hop because everybody thought, well, the Fed's in control of interest rates. They're in control of bond yields. And therefore, then, we're now down at zero. They're never going to go up again. That was actually a pretty common thought.
Yeah.
Without, they just didn't understand the role of interest rates. So they've all got caught. You had some regional banks who went under in the States, or rather were rescued, had to be rescued. And so far, what's happened is that we ran up to close to 5% on the 10-year, if I just use the 10-year. And the Fed funds rate went, tad over 5%. And now, of course, everybody is thinking that interest rates are going to go lower. No, they're not. They're not, because of this risk, the risk that foreigners and large investors face in buying dollars. The compensation isn't enough. They can see, particularly with Donald Trump coming in with his tariff policies, which higher tariffs are paid by consumers, so that'll push up the consumer price index. At the same time, he's a spendthrift. I mean, you're not going to get a cut in government in the government deficit, the budget deficit. That's going to increase. And that is highly inflationary. In other words, what I mean by inflationary is it undermines the purchasing power of the dollar. So here you are as a foreigner looking at the prospects of supporting the US government by buying their debt. Do you want to do it? Not at these rates, mate. No. So what rate do you buy this at? Well, you look at the arithmetic and you see, the economy is actually not growing. I mean, if you adjust the economic growth, which according to the Congressional Budget Office, which revises figures back on the 7th of this month. I mean, it's pretty hot off the press. They expect the US economy to grow by 4.5%, roughly. But if you take out the budget deficit, which is approximately 8%, we're talking about the current fiscal year to September, then you can see that the increase, that growth, so-called in GDP is actually all government spending. And not only that, but in order to balance the relationship between the deficit and the supposed economic growth in GDP of 4.5%, you've got to take 8% minus 4.5%. That's how much the private sector is contracting by. So, and you do this for every government which has a huge or a significant budget deficit. And furthermore, they're doing this with levels of government debt to GDP, which are unheard of. I mean, America is at what, 125, going on 130, 135%.
Mm.
So as a foreigner, you're looking at this and you're thinking, well, you've got a contracting private sector and you've got a debt to GDP of 135%. You have got current interest costs of, let's say, roughly 5%. Where's this going to go? I mean, the answer basically is they're in a debt trap. And when you're in a debt trap, what happens to the interest rate? It shoots up. So the outlook for 2025 is far higher bond yields, and you can kiss goodbye to any thought that interest rates are going to go down.
Wow.
So that's roughly where we are.
I'm almost like regretting asking you that question because that's pretty depressing, right? I think like a lot of people probably think, hey, interest rates are going to go down because they started to come down. It's just going to keep on going. But you hear the counter to that, and often it's too shallow. But what you just explained before actually makes a lot more sense. Like I will have to actually rewind this and listen to this like three more times to fully get that. But like what you're basically saying though is it gets to a point where the interest rates have nowhere to go but up. That
Yep.
leads to mass defaults, which
Yep.
cascade through the entire system. Is that effectively what
Yep.
the credit crisis would entail?
Yeah. I mean, basically, in effect, what I'm concluding is that having kicked the can down the road, sort of in accumulating bubbles since 1985, there's nowhere now for the Fed to go. They are in a very difficult position. And I can't, I mean, they're going to have to choose really. Do we go with the mandate to rescue the market, rescue everything at the expense of the dollar, or do we protect the currency and let everybody go hang? That's really the decision they've got.
Like which one would they
So,
do? Would they save the system or save the participants in that situation?
well, this is the decision they're going to have to take this year.
Hmm.
And so it'll be watch that space.
Wow. Okay.
I mean, I would guess, I mean, their economic analysis and their inclination, I think, would be to try and rescue what they can.
Hmm. Okay.
So that drives down the value of credit, dollar credit. And going back to what I was telling, the difference between money and credit, you can see that the purchasing power of credit is going to decline relative to that of money, which basically will be reflected in higher gold prices.
Right. Hence the debasement trade, right? Like
Yeah.
you're buying
Yeah.
gold not because the gold value is growing. Well, I guess it would under a credit crisis event, right? It would totally grow in a
Yeah.
sense, but it wouldn't. It would grow denominated in dollars. Well, it would go effectively to infinity because the dollars are going to absolutely zero under this situation. Is that fair?
Yeah, the purchasing power of money, by which I mean gold
Sure.
specifically, it does vary a bit, but basically, it doesn't vary that much. It varies considerably less than that of paper credit.
Sure.
I mean, I've said this so many times. If you look at Diocletian's edict, which of maximum prices, which was around about 303 AD. I mean, a long time ago, you can see a commonality of values measured in gold from there to today.
Hmm.
Um, and that shouldn't surprise us, really, particularly when you know that the increase in the above ground stock of gold has been roughly at the same pace as the increase in global population. So, gold is a constant, as it were. That is the constant. The variability is all in the paper credit, and
Right.
that's when you get higher risk, then you can see what's where do you want to be?
Yeah, well, it's like the Matrix, right? We're so plugged into the Matrix, and when we're investing and we're denominating everything in credit, is what you're saying. Whereas
Yeah. Well, we run our balance sheet in currencies, and we're taxed on the basis of our profits in current currencies. So we automatically think in terms of, we'll buy this because we think it will be a higher price. What's the price in currency?
right.
So yeah.
Okay. So like thinking about last year though, 2024, and just denominated in dollar terms at the moment, the performance of gold denominated in dollars was almost 4% higher than the S&P 500. And normally, from what I'm aware of anyway, the stock market pumps. Usually that occurs when the gold price isn't pumping. So when they're both going up at the same time like this to this magnitude, is this a signal that the credit crisis is approaching faster? That when you see weird things like this happen?
I think the comparison between say the S&P and gold, forget it. That's an absolute nonsense because really what you're saying is my alternatives are to invest in, um, if you like, a number of equities or to invest in gold. Now, to invest in gold means that you don't actually understand the role of gold. Gold is money, full stop. You don't invest in money, you hold money.
Hmm.
You hoard money. You don't invest in it. Indeed, you need credit in order to be able to invest in something. So, basically what you're doing, your decision isn't investment, it's just getting the hell out of credit. So the comparison doesn't make any sense at all. What makes more sense is to understand that the purchasing power of the dollar against gold last year declined by roughly a quarter.
Okay.
And this is important because at that rate, it is declining at an accelerating rate. And of course, nobody really has woken up to the implications of that. If credit is going down at an accelerating rate, then, that is extremely serious. And this is something which you need to really hoist on board. But what people assume is they see gold has risen by 25% in 2024. Okay, that's been a good investment, to use your comparison.
Hmm.
It's not an investment. You know, it's, if you like, protection. This is the whole thing. And, the whole of the commodity complex, which incidentally last year I think went up about 18%, is also pretty tied to gold. I mean, I ran a series of charts of looking at commodity prices in priced in gold as far back as I could go. I mean, I could take copper back to about 1900, I think. And yes, there's some volatility in individual commodities and raw materials, as you would expect, because supply changes. I mean, they find new discoveries of copper or whatever, or tin or zinc or iron or whatever, or they're not finding them, and so this has an influence on individual ones. But if you take the metals complex, for example, and you look at the value of it priced in gold, it's pretty constant over time. So, gold, if you like, is also telling us that commodity prices are rising. Yes, confirmed because they rose last year by, I think, if you look at sort of broad-based commodity ETFs, you're looking at something like between 15 and 20%. So that all fits in. And gold is probably rising a bit more quickly than that today. In other words, it's the commodities are lagging it a bit, but then you would expect that in this situation because gold is money, and what people are doing is they're beginning to anticipate the degree to which credit is going to devalue in the future. So obviously, gold gets a little bit of a premium due to that fact.
Okay.
So we're at a very interesting junction here, Darcy. I mean, it really is a very, very important point.
It is, and I guess I'm just like in my mind, I'm kind of just reflecting on a few conversations I've had with some of my clients and even just some of the rewiring that probably needs to go on in my mind to fully kind of align myself to this gold is money, everything else is credit reality, right? Because I
Yep.
know a lot of people that would go, well, okay, I'm going to just jump into gold ETFs. They're, yeah, okay, I'm jumping out of the fire, but I'm really, or I'm jumping out of the frying pan, but I'm jumping
Yeah.
into the fire, right? Because you're still in a financialized product where credit is attached all over it, and you're not, you have a promise to the benefit of that ETF, but you don't actually have the rights to spend that money because it's captured by it, right?
Well, I mean, you're getting there.
Okay, good. I'm making
I mean,
progress.
the thing about an ETF is
Yeah.
an ET. You know, if you buy an ETF which is fully backed by gold, you do not possess the gold. You don't even possess the shares in the ETF because you
Mm,
will. I mean, you may possess a bit of paper saying you are the owner of shares in the ETF, but given that all you have is an obligation for the managers of the ETF to deliver the value of gold to you as a shareholder, then you have got credit.
mm,
On top of that, as I said earlier, if you've got your ETF held in non-certificate form, you have got another counterparty like Euroclear in the middle there. And the important thing is that if Euroclear, if the system has a meltdown, if the credit system has a meltdown, the fact that you do not possess the gold suddenly becomes terribly important because Euroclear, if it's through Euroclear, will use that as collateral for its own purposes because you have delegated the property in the obligation, as it were, to Euroclear. It's not yours. You know, I mean, Euroclear can turn around and say, look, we've got a crisis. We've got to do this, that, and the other thing. Yeah, we recognize we've got an obligation to. Yeah, don't worry. We recognize that. But you're not owning gold. And if you have a collapse of the credit system, tough. That's it.
mm.
So this is why ETFs are not ownership. Now, the whole thing is compounded because if you, as an investment manager, I mean, you'll know this. You've got investment regulations, which I guess in New Zealand are
Yeah.
similar to everywhere else.
Yep.
Gold is not a regulated investment. Now, if you go and buy gold for your clients, you're going to have a compliance officer who's saying, "Look, I should draw your attention, Darcy, to the fact that this is not a regulated investment, and therefore you have to be strictly limited in this activity."
Mm,
However, if you go and buy ETFs, which your compliance officer will encourage you to do, they'll say, "Well, that is the equivalent of buying gold."
mm,
So you can see, because that is a regulated investment. The whole idea of packaging it up in ETFs is to turn something which isn't regulated into something which is regulated, and therefore the compliance officer and you can sleep at night.
mm. So I guess what you're saying is that if you're going to hold gold, not invest in it, but if you're going to hold some of your wealth in real money in gold, there is no alternative really apart from holding it physically. That's basically what you're saying.
Correct. I mean, it's not just the obligation; it's possession.
Mm,
It's ownership and possession. You need those two things to be satisfied.
sure.
Now, there is an argument rather than have substantial quantities of money, in other words, gold, silver, maybe, in your own personal possession, and have the risk, if you like, that entails. Then you can store it in, a fully insured
Bank
vault.
gold. Yeah.
And you might want to take the view, as many Americans do, incidentally, that having seen the confiscation or the attempted confiscation of gold back in 1933, that you want to store your gold as an American citizen in a foreign jurisdiction and in a vault not owned by an American company, for example.
Sure.
So, get it beyond the reach of your government. So, to have the choice of different jurisdictions makes quite a lot of sense. So I think that might make sense if you've got significant wealth, rather than having it exposed, if you like, to criminals in your possession, then this is an alternative. But I would certainly say that it makes a lot of sense to have gold in the form of recognizable coin.
Sure.
I mean, we have sovereigns, and of course, I suppose sovereigns would be acceptable in New Zealand. I mean, the thing about the sovereign, and this is actually quite interesting, to give you an idea how detached credit has become. A sovereign was exchangeable for £1 as late as 1932.
Hmm.
Do you know how many pounds make up a sovereign now?
No, no.
540.
Wow.
So, this is what happens when you detach credit from money.
Yeah, yeah.
And who realizes this?
Not
Very
many.
few people,
Not
not
many,
many.
if any.
Virtually,
It's like
virtually
the
none.
yeah. Yeah,
You,
and
you, you've got you and me now, and that's about it.
well, hopefully people are following along. They're catching up. But it's kind of
Well,
like
this
the
is it. This is why, I mean, Darcy, this is why I've set up my Substack. I just want to get this message out, get people understand
yeah,
the difference between money and credit and why it is so vital to understand it.
yeah,
And so it's podcasts like this that I find
yeah.
so helpful.
Okay, and I am going to put the details for people to subscribe to your Substack channel as well. So I want
Please
to ask
do.
you just two more questions. The first one is in relation to central banks, because and I kind of get this now a lot more just based on our conversation so far, that if you were a central bank, if you were a government, if you were a nation state, you don't want to play around with this funny money. You don't want to play around with dollars at the moment, right? Like if we are aware of this, then surely people at that level are more than aware of what's going on, and they're going to want to get rid of credit as much as they can, central
Yeah.
banks, that is. And that kind of now explains why they're accumulating gold so much. So is that kind of what's going on? Is that they see the writing on the wall, and so they are preparing either for some sort of fiat currency failure in the system, or they are preparing for a new financial system of some sort? Is that why central banks are gobbling it all up?
I mean, basically, they've got the message. Let's put it that way.
Okay.
Now, I think it would be too far in advance of events for any central banker to say that the whole system's going to collapse and therefore we've got to get into gold. I think what they are assessing is that there is a greater risk attached to paper currency. And therefore, it makes sense in their reserves to increase the proportion of gold. So that's basically what's been happening. There are also geopolitics comes into it to an extent. When sanctions were taken out against Russia, for example, basically the West stole the central bank of Russia's reserves. There's no other description that applies to our actions. We took something like $300 million equivalent in basically dollars and euros away and stole it. Now, Putin then turns around and says to international financial forums in St. Petersburg, I think the first one was in 22, attended by some 80 different nations, 14,000 officials, and all the rest of it from all the way around the world, and said, look, this is what the West does to you. They steal your money, your currency. They steal your currency. And if you've got gold stored anywhere, like London or New York or whatever, get it in your own possession. And the message was received loud and clear. And
Ah,
this is one reason I think why government wealth funds are also, if you like, shifting the balance between money and credit in terms of their portfolios.
mm,
Um, and it is clear from various writings that have come out of Russia. I mean, people like Sergei Glaziev, for example, have written about going back on a gold standard. Um, but politics gets very much in the way of this sort of thing. So you've got to sort of read between the lines a little bit. But it is absolutely clear that the Russians do understand that a gold standard for the ruble would actually be a very, very good thing. They could go on a gold standard tomorrow. I think their relationship with China, however, stays their hand because China does not want to trigger a collapse of the Western currency system. That is absolutely clear.
mm,
China, however, is prepared for a collapse of the Western currency system. She's been accumulating gold for a very long time, secretly, all
mm,
the way since 1983. I have evidence of that.
mm.
I reckon that China has undeclared gold reserves hidden in various accounts like the PLA, the Communist Youth Party, all this sort of stuff, in excess of 20 to 30,000 tons. And not only that, but she also encouraged, I mean, once she'd got enough by 2002, she then set up the Shanghai Gold Exchange and permitted Chinese citizens to buy gold and own it themselves. And they advertised on television in the early days, buy gold, it's good for you, whatever, whatever. And now they've got something like 27,000 tons. So you can see that there's, probably 60, maybe even as high as 70,000 tons of the round about 200,000 tons of above ground stocks are actually now in Chinese hands. They're well prepared for a return to sound money,
Right.
if you like, as the basis of value and credit.
Right.
But they know that at some stage the Western system is going to collapse. That actually they taught in the Marxist universities that capitalism will lead to its own destruction. So this is not news to them at all. They're just coming at it from a rather different angle. But they can see this is going to happen. So for them, instead of precipitating a collapse, they would respond to a collapse as it happens to secure the value of their own currency. I believe that that's so. We're going to have both Russia, China, and the people who are closest to them going on to gold standards as our currencies collapse. And that is going to be the final death nail for our currencies. But that will only happen when they've really got no alternative.
And will that happen in a coordinated manner for the reasons that you just outlined, that no one really wants to be going first, but it's in everybody's best interest to kind of be prepared for when it happens. Is that right?
Yeah, I believe so. That would make sense.
Wow. Okay. All right. Now, as we come to a landing here, I would be doing some of our audience a bit of a disservice, and myself as well, because I'm quite interested in this space. I know that your views on Bitcoin are not exactly for Bitcoin. You're not quite on the Peter Schiff extreme end of the spectrum, but and your reasons that you give are actually quite intelligent. I think anybody who is into Bitcoin should understand and fully appreciate all of the risks. So that's what's kind of informing this question. You've expressed concerns in the past that Bitcoin's viability as a long-term store of value, like relative to gold, is just no good. So can you just explain to me how, especially if a credit crisis event was to occur, why would Bitcoin just not perform very well relative to gold?
Okay, well, the first thing to understand is that Bitcoin has no legal status as money. It's as simple as that. And not only that, but it is completely unsuited, if you like, as the to secure the value of credit. I mean, look, it's far too volatile. I mean, if let us say in hodler's dreams, Bitcoin was to become money. As I've pointed out, the relationship between money and credit is money doesn't circulate, it's credit which circulates. And credit has to be has its value based on something. If it's going to be based on Bitcoin, I mean, just imagine that you want to build a new shoe factory or something in New Zealand. Okay. You know that it's going to take, say, 4 or 5 years to establish a factory, get the whole thing together before the first shoes come off your production line. Okay. You're going to need financing. You're going to need credit. Okay. Because you don't own the Bitcoin to do this. You're going to own the credit.
Yeah.
Credit based on Bitcoin. Now, how can you do your business calculation based on so-called money, Bitcoin, which is so incredibly volatile, unpredictable, and according to Bitcoin hodlers, going to increase in value? I mean, it's going to make it absolutely impossible. It just can't work. So, while people have sort of got this sort of simple concept that, Bitcoin is limited in terms of its final quantity, whereas government currency is infinite and increasing the whole time in its quantity, then you look at the quantity of one against another. Well, what happens is that the price of Bitcoin is going to rise and it's going to go through $1 million and whatever you dream. But what they haven't understood is the relationship between money and credit. The world works on credit, so it's completely unsuited. A further point in answering your question is if you look at Bitcoin and see what it correlates to. It correlates to the Magnificent Seven tech stocks in the US. In other words, it's the same cohort. It's a sort of surrogate tech stock. Now, when credit gets withdrawn from markets due to higher interest rates, then Bitcoin will collapse along with the rest. I can make that prediction with great comfort. I
And
mean,
not necessarily gold in that situation. Is that kind of what you're insinuating?
well, no, no, no. Gold appears to continue to rise because the value of credit is declining the whole time.
Under that.
But
Okay,
because
got it.
interest rates start rising, that collapses the equity market and particularly the momentum stocks, not the value stocks. You know, the Teslas and all the rest of it. I mean, Tesla's a fascinating situation because it's sort of the price is somewhere up there, at all-time highs, and yet Musk is, sort of, if you like, backing a president who's backing out of all the climate change stuff. This is not good for Tesla. And not only that, but they're losing market share in China. Oh, and by the way, there's a trade war going to escalate against China, where he's got manufacturing. So why are Tesla shares rising? I mean, this is just crazy, absolutely craziness. This is all momentum stuff.
Right.
Screw values. We're not interested in values. We're going to buy it because it's going up. That's the logic. It's
Right.
exactly the same with Bitcoin because it's the same cohort who are buying Bitcoin.
Sure. Got it. Okay. I said that was the last question. I lied. There is one more question I have for you, Alistair, before we finish up. So, I'm not even going to dare ask you for timeframes, by the way, because it's just hard to guess, right? But what's the most likely scenario to unfold as a result of a credit crisis scenario? Is it going to be either the end of the fiat financial system and by extension, I guess, the end to central banks, maybe? Or will it be an evolution of fiat currency in the form of CBDCs or something else?
Well, forget CBDCs. I mean, I think that's just a distraction.
Good.
It's a whole different topic. I'm not
Yeah.
going to go there.
Yeah.
I think that President Trump's election is actually going to speed up the decline in the purchasing power of credit.
Hmm.
Um, because he's going to drive up, the CPI, which everybody thinks is, inflation and so on. People misunderstand inflation. It's really, if they understood that it's a decline in purchasing power of the currency, then, they get a better grasp of what's actually going on. So that's what's going to happen because basically, when you got tariffs against the EU and against the Chinese, who pays for it? The US consumer in higher prices for the goods which are imported. What's the whole point about tariffs? He wants to stop the imports, if you like, coming in by pricing them out of the market. So your CPI is going to rise. And not only that, as I said, the most inflationary aspect from a monetary point of view or from a currency point of view is the budget deficit. Why? Because you've got something like 8% of GDP being spent into the economy by the government non-productively. So that is basically what's going to drive up prices, which is the same thing as saying the purchasing power of the dollar is going to go down. Now, the fact that Trump is now president and is pursuing these policies quite aggressively, I think speeds up the rate of decline of these currencies. How long it will take, I don't know, but it's going to rapidly drive, I think, the whole of the financial asset-based system into crisis.
Hmm.
And I think there's a very strong possibility we'll see that this year
Hmm.
rather than in future years.
Wow. And will that end the function of the central banks, or will they simply reinvent a new currency system or a new type of fiat currency system off the back of that?
Well, I mean, central banks will continue to exist. I think it's as simple as that. The problem that the Americans have, I mean, we've got a dollar-based system, and we've got to evolve from a dollar-based system back into a system which respects that gold is money and nothing else. Going back to J.P.
Yeah.
Morgan's,
Yeah.
gold is money, all else is credit. We've got to understand that again. Now, the macroeconomic sort of economic community, as it were, don't understand this. And so they're going to have to re-educate themselves. The whole of macroeconomics has got to be dropped. It's rubbish. We go
Keynesian
back to basic
specifically.
economics, pre 1936, pre Keynesians or Keynes's general theory. The economics that existed then uh, were broadly a lot more accurate than what he then brought out. I mean, he gave birth to the whole of this macroeconomic thing, government intervention, da 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 da,
MMT.
statistical based. It's completely wrong. So they're going to have to. There's a big re-education problem. There is another problem, Darcy, and that is that America has been suppressing money in favor of its currency since at the end of Bretton Woods in 1971. And it has gone on a deliberate policy of trying to get gold out of the monetary system. And in the process, there has been a lot of financing for the US government out of gold. The carry trade, which really existed, particularly in the 1980s and 1990s, and I think into the noughties as well. I mean, basically, what happened was that central banks lent gold at the lease rate of 1%, whatever, to banks like Goldman. Well, in those days, Goldman Sachs wasn't a bank, but outfits like that and banks who would then sell it into the market, which helped drive the prices down, of course, and invest the proceeds in US treasuries, which were yielding over 10%, dropping through down to 5%. But you can see 2% makes 5. This is a worthwhile trade.
Mm.
But Frank Veneroso, who is an analyst who did some serious work on this, said in 2002, he reckoned that somewhere between 10 and 16,000 tons. So, in other words, slightly more than half total central bank gold reserves at that time was out on lease and was adorning the necks of Asian women. In other words, if you open Fort Knox, you'll find a whole bunch of IOUs because it's not there. And of course, we should have been very alarmed at the New York Fed's reluctance to return Germany's gold to it, if you remember.
Yeah.
And they were talking about fairly small quantities. And the other thing is that the reports every time, that America organizes a regime change, the Black Hawk helicopters come in with these chaps who basically take the gold out. This was the case in Ukraine back in 2014. So, there's a lot of skullduggery, if you like,
Yeah, I'll
because
say.
I don't think America's got the gold it says at all. And furthermore, it's taken other people's property, earmarked gold, held by other nations, and deployed it for its own use. For America to go onto a gold standard, I think it's going to be extremely difficult. I really do.
Yeah.
I mean, both intellectually and also from the practical point of view.
Yeah. But if they don't pull finger, then the Russia,
But
China,
look,
they
what can
will.
they do?
Yeah.
What can they do? I mean, it's all very well saying make America great again, but it's just going to go down a sinkhole on this one.
Yeah. Make America golden again. Okay. Whew. Awesome. Well, yeah, thank you very much, Alistair. I really appreciate your time today. Again, if people want to follow you on Substack, where do they go? Where do they go for that? Like, I will put a link in the
Well,
notes.
the real address is alastairmacleod.substack.com. But if you Google Macleod Finance, which is a lot easier,
Yeah.
and that's Macleod, then you'll get directed in going there. And as I say, really what I want to do is to educate and inform people on this vital topic, and it's vital to their future financial survival and indeed their ability to feed themselves in the event of this turning out into the ultimate catastrophe.
Wow. Again, thank you very much, Alistair. I'll leave you to the rest of your day, and thanks again.
Thank you, Darcy.
All right. Take care.